What is PMI? Is it a good thing? Is it a bad thing? What is it?
Real quick, PMI is private mortgage insurance, okay? And it's something that protects the lender, it doesn't protect the consumer.
Shocking.
Okay? So why is that around, PMI? PMI is around for anybody who doesn't put at least 20% down on the purchase of the home. Okay? And lenders want to be protected for if that home goes into default. Okay? I guess the calculations that they figured out, if the lender doesn't have at least 20% equity in the home, okay, with attorney fees and go through all the foreclosure process, they're going to lose money. So they like to hedge themselves and hire third-party private mortgage insurance companies to hedge themselves. But that PMI goes into a buyer's mortgage payment in case that happens, foreclosure down the line.
And how much normally is PMI?
PMI is one of those things that is credit score driven.
It's credit score driven.
Okay, and also down payment. So if you put down 3% compared to 15%, obviously if you put down 15%, the premium will be lower. Same goes if you're a 640 credit score and you're a 780 credit score, the premiums will fluctuate. So it's hard to come up with an exact number. If you have great credit, the PMI is not like it used to be.
Good. How long before the PMI drops off?
VA is one of the loans that does not have PMI. So that's another benefit of a VA loan for veterans. Okay, they can put down 0%, get a fantastic rate, and have no PMI. So that's a bonus. That's pretty much the only loan. Conventional, generally, if you put down, let's say 10%, so there's a 90% loan to value on the property. Once the loan to value gets to 78%, automatically it'll drop off. However, if you think you've paid down principal and you want to get a new appraisal and your house value has gone up, once it gets to 80%, you could write to the lender and potentially get the PMI removed. FHA, the other loan, that's one where it's kind of, I think it's pretty much 11 years. Okay, if you put down the minimum, 3.5% down in an FHA loan, it's going to be on there to at least 11 years.
What are seller concessions? I know we get this question asked all the time. I know I do a good job of explaining it, but give us the exact definition and then what it means, and then I can explain exactly what it means in an active contract.
Seller concessions, also known as seller credits or seller contribution, it's a way to pretty much roll in the closing costs into the purchase price. Okay. Some people like to say sellers paying the closing costs. That's the easy way to say it. Technically, negotiating wise. Seller's going to take his net number. Okay, so if you have a house listed at $200,000 and you want to roll in closing costs, in this market that we're in especially, the seller's still going to net his $200,000. You roll in $10,000 of closing costs, so that would be $10,000 in seller's concessions. So then the purchase price is now $210,000. $10,000 goes to the closing costs, so you don't have to come to the table with it, and the seller still gets his $200,000, and everybody's happy. The caveat is on that, the home must appraise for the inflated purchase price of $210,000.
That's very correct. Most people, they're going to come to the table with, they think, I just have to have enough money for my down payment. Well, there's all of these other costs, like the closing costs that we're just finding out about. Some of us already know. I know I do. Savvy buyers or first-time home buyers who really have gone and done their homework know about them. But generally, with having those seller concessions, it just allows somebody to pretty much just come to the table with what they originally thought of, which is their down payment.
Correct. So, a first-time home buyer, conventional client with great credit, you can get in the house for 3% down. So in a $200,000 purchase, that's $6,000 just for the down payment. And now, depending on their property taxes, you got to figure there's another $8,000, $10,000 to $12,000 on top of the $6,000 down payment for the closing costs. So that $8,000, $10,000 to $12,000, a lot of people don't have that money. And that's the big hindrance of people not buying homes is the down payment plus the closing cost.
It's always a good thing for a buyer, but in a competitive situation, it's not always the best option.
I agree 100%. In a buyer's market, you correct me if I'm wrong, buyer's market, homes are on the market for 6 months or more. Or neutral market, 3 to 6 months. However, we're in a market where things are going, 24 hours, 48 hours?
So I've seen 6 hours. There was one I saw 2 hours, called on it, and it was already under contract. The market that we're currently in, this is a very strong seller's market. So 100%. The seller concessions can be a little challenging to work with. With that being said, when you have somebody like myself this beautiful face. And Bryan, we are able to work a little magic if we can. How many years of income does somebody have to have in order to obtain an approval?
Generally, they want to see 2 years. Generally, a 2-year history is what we got to put on an application.
2-year consecutive?
2 years consecutive is what you
Okay.
look for. Obviously, there's always exceptions. FHA, like I mentioned, is a lot more liberal. Coming out of school, you get a job, you're out for 1 year. You can prove you were in school before that 1 year of employment.
Right.
You can potentially get an approval.
Okay.
Big things that are no-nos are gaps in employment.
Okay.
So you work somewhere for a year, you took 8 months off, you changed fields, now you went from a cook to a construction worker. I mean, so it's kind of that, a labyrinth, like I like to say on the pre-approvals, where we have to connect the dots and try to figure out, what goes on. But it's generally 2 years.
Right, okay. So say somebody goes from being a salaried employee to wanting to do something that I do, and they become a 1099. Trust me, if you guys want to ask more questions on this, call me, I can explain it. They become self-employed and they're making more money for themselves. Like and one would think if they're making more money, then obviously they can afford a mortgage. How does that work for those people?
First thing I would always ask is, did they change fields?
Right.
All right. So if you go from, a construction worker to a realtor, that's, 2 different fields. We can sometimes prove that you're making a career move,
right,
advancement, which would help. But when you go from 1099, when you get a 1099, basically you're getting income without paying tax on it.
Right.
So lenders don't use that. Okay, lenders only use taxable income. So the only way to prove income on self-employed borrowers is by tax returns.
Okay.
So in this example that he mentioned, if he turns, a realtor for 1 year, you have to work for 12 months, file your taxes, okay, and whatever that bottom line number is, after write-offs, that's what the lender will use. So that's something 12 months being a realtor, can we get it done? Possibly. But it's a lot of things that have to fall into place.
And that's very important for self-employed clients. I know we've had to break a couple hearts, even though they very much could have afforded the mortgage. It was, when you look at their cash flow, there would have been no problem. But the thing is proving that income, which is basically what they would have to do. So for those people who are self-employed, would you recommend that how would you recommend them going about this? Because people who are self-employed, we like to mitigate our taxes as much as possible because we know Uncle Sam likes to stick their hand in there. So what was the best advice you could give someone who is self-employed that wants to obtain a mortgage?
Self-employed, like I said, it's taxable income, okay? So if somebody hands me a $300,000 1099, I get his tax returns and he wrote off $280,000 of that $300,000. To the bank's eyes, he only made $20,000 that year. All right. So I always tell people it's a catch-22. You got to pay your taxes. You got to get the taxable income up if you want to, buy a home and get a mortgage in this market. 2008, I was giving $500,000 mortgages to people who were, making $40,000 a year. The investors were buying those mortgages. They were called stated no income, no asset loans. Wall Street took the paper, we wrote the loans. Nobody figured that there would be a problem. Nowadays, self-employed borrowers, they get scrutinized heavily. So it all comes down to the tax returns. They're going to ask for profit and losses so it's tough. But you just got to pay your taxes. You can't write off everything under the sun. And it's the bottom line number, unfortunately.
That's good. I mean, we all need to know that. Can you explain to me what points are?
Points are discount points. Basically, when I quote out rates on a pre-approval or a mortgage, I quote out par rates. Okay,
Right.
Par rate is you won't get a credit for the rate and you won't have to pay for the rate. It's just par, flat.
Yeah.
Okay, you can pay points to buy down the rate. Okay, so on a $200,000 mortgage, let's say, you can pay 1%, which would be $2,000. That would now go into the closing cost to buy down the rate. Okay. So what you do is you figure out what the savings is between the par rate that you didn't have to pay for and the discounted rate when you pay the point. Okay, find out the monthly payment difference. Let's say it's $20.
Yeah.
Okay, so in the $200,000, it cost you $2,000 to save you $20 a month. Okay, you divide the $2,000 by 20, you get 100. That 100 number is 100 months. it will take to recoup that $2,000. Okay, so that's about 8.5 years to recoup that 2,000. So was it worth it? I don't know. Average person, stays in their house, 5, 6, 7 years?
Actually, it's gone up to 13.
Is it?
Yes,
okay,
it's gone up to 13. That's why we're needing some inventory. Sellers, please call me.
See that? So in this case, if you know you were going to stay in your house for 13 years, it would make sense to pay that point, because after the 8.5 years, you're now truly saving money.
That is all the questions we have for today. I know there's so many more that can be asked. And Bryan, what number can our viewers reach you at?
Cell phone's always on, area code 631-236-2527. Again, I work for Aamtrust Mortgage in Clifton Park. If you contact Jason, he'll be able to send you my way, and we can do things the correct way.
Yes, definitely. We've seen Bryan catch a couple things that other lenders didn't, and it has made for a much smoother transaction. He very much does his homework right in the beginning, which is what you want, so that way you don't have any hidden surprises.
Correct. The last thing you want to do is, fall in love with the home when, the pre-approval, the person should have, found out in the beginning, listen, it's not going to fly. Fortunately, I don't work that way, and Jason, I think, and his team appreciates that. Where I'll tell you right up front, listen, this just can't be done. You got to wait 6 months, 12 months. You got to get that credit score up, or whatever it might be.
I want to thank you. Very welcome. Thank you for coming, and till next time, I will see you guys later. To stay in the know, smash that subscribe button, and I'll see you soon.